Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
We appreciate you being here, John, for another edition of Financial Focus, and going to be talking about some developing news, which is the collapse of Silicon Valley Bank, a couple other banks across the nation as well, and what that means for us as individual savers and investors, for the economy, for the stability of the banking system. As a reminder, ladies and gentlemen, this is Financial Focus. We are here with John Kuykendall, founder, CEO of GulfCoast Financial Services and Financial Focus, and they have been named Best of the Best in Financial Services 8 years and running by the readers of the Lake City Reporter, serving North Central Florida savers and investors for more than 31 years. And John, you've got a background in banking even prior to that, so maybe you can provide some insight on this bank collapse that we may not be able to get many other places. So Silicon Valley Bank was taken over by the Fed. What caused this problem? What do we need to know?
Well, Peter, it's a typical example of a bank doing what they're not supposed to do. This bank, which has grown rapidly, very rapidly over the last 10 years, made a lot of venture capital loans. That was their specialty. They made these loans to venture capital, risky loans. And then they also, because they brought deposits in from those people, they went out and bought a bunch of T-bills, T-bonds, in the secondary market. And as interest rates rose, as we know from the Fed having raised interest rates for the last year and a half or year and 2 months, those bonds were worth less than they were before. As interest rates rise, liquidity or bond prices go down. So those bonds were not worth par. They couldn't get out for what they paid for them. So it was a situation of a lot of things coming together to drive this bank into illiquidity and making it insolvent so that they couldn't meet their capital requirements. And when that happens, then the Fed has to come in and take over. The FDIC, and in this particular case, because this was a national bank, and the Office of Treasury came in and took this bank over. Now, this isn't something that hasn't happened before. And, I read posts on Facebook like, get your money out of the bank before it's gone, and all these stories about you're going to lose your money if you don't get it out of the banking system. I was in banking for 20 years. I've been doing this for 30 years. So over the last 50 years, I've seen banks come, I've seen banks go. I've seen the thrift crisis in '86. I've seen the 20% prime in the early '80s. All those things, and the 2008 real estate collapse. All those things have driven banks into insolvency and being taken over by the Fed. But in every situation, every depositor got paid. And that's the whole thing for the banking system, is it's an implied guarantee by the government. The FDIC insures every deposit up to $250,000. Now, is there $250 worth of collateral somewhere to back up each individual? No, it's an implied guarantee that the government has issued, and they always have come through and done what they were supposed to do. And they did in this case. They came in, and as of Monday, yesterday, everybody was able to get their money, every depositor, whether they were overinsured or, had over 250,000 or under, were able to have access to their accounts.
I'm glad you mentioned the financial crisis of 2008. In your perspective and opinion, John, how does this compare? Do we need to worry about the same kind of set of scenarios and dominoes, or do you feel pretty confident in your client accounts, deposits, and those of investors across the country?
Oh, I feel confident. I haven't run down to the bank and taken my money out. I think that it's an individual situation. It's a situation where banks make bad bets sometimes. And in this particular case, they tried to arbitrage the rates that they were paying on deposits versus what they were getting in the bond market. And that worked fine until the bond prices started going down and interest rates started going up. Now, there's a problem here in the fact that, Peter, as well as I do, that we're fighting inflation right now. And the Fed is raising rates. So by the Fed going in and taking out these banks and making the depositors whole, they've had to actually buy some of those bonds, put them on their books. They've had to go in and actually issue debt in order to take care of this. And so they are actually creating more paper debt for them, which is creating more inflation. So, it's a catch-22 here. We can't do this without creating some kind of scenario. The interesting thing is that the market is reacting because we believe now that the Fed won't be able to increase interest rates at the next meeting as much as we thought they would. So, that has created this quasi-well of the market all of a sudden, which I believe is going to be short-lived because the Fed has to increase interest rates going forward in order to cut inflation.
More than just a catch-22, it sounds like a bit of self-inflicted pain here, and that vicious cycle that we always hear about. John, you mentioned the Fed controls the interest rates. Because the interest rates went up, the value of the Treasury bonds went down, which is what in fact caused the fractional reserve requirements for Silicon Valley Bank not to then be met. And then the Fed has to step in and buy the bonds back, essentially.
Right.
Full value.
Right. Well, that's right. And there's no good scenario here. This is one where the depositors were insured. They got their money. That's the good thing. The bad thing is there are going to be consequences that we're going to face, but they're not going to be consequences that we can't face. And so we'll take a short reprieve here from interest rates going up as much as they should. But I believe that will be restarted in the future, and rates are going to continue to go higher until we can get control of this inflation. Peter, the government created this problem. We created way too much debt in 2020 when we had COVID. We put way too much debt on the books. We created too much stimulus, and all that has spiraled since then and created this 8 to 10% inflation. And I know every time I go to the grocery store, I see it, and I know you see it.
What are you watching for next, John? Where do you think this ends up?
Well, I think that what's going to happen is that we're going to have stiffer regulation on banks. I don't think it'll affect the individual consumer. I think it will affect banks. And that may be a good thing. A bank shouldn't have done. It's kind of like the Bernie Madoff situation with securities. That he never should have gotten away with that. And the banks here shouldn't have gotten away with what they did. It was a bet on their part. It was bad banking, and they should have stuck to what they knew. They had 18% consumer loans on the books. The majority of their loans were in Silicon Valley were to venture capitalists. Never should you have that kind of concentration in one particular lending group.
And what are you talking with your clients about during this time, John?
Well, I'm telling them that interest rates are going to go up. We can't, just because the market's going up today and it's gone up a little bit yesterday, we may have this short bump in the market. And so we don't want to get overzealous and put all of our bet on aggressive growth stocks right now. We want to stay diversified. We have a plan, being very conservative, being very income oriented, and we want to stay that way. The raising of interest rates isn't over. It's coming. We're going to have higher interest rates. We're going to have higher taxes. And so those are two givens that have to take place. And so we might as well sit back, enjoy this little bit of lull that we're getting in the raise of interest rates, but they're still coming. But don't overreact. There's no reason to take your money out of the bank. There's no reason to feel like you're not safe or secure. That implied guarantee keeps the banking system going. It's kind of like the life insurance guarantee, the payout on life insurance policies. that you have no guarantee there except the insurance company itself. But we've never had an insurance company fail to make a payment on a policy, or we'll never be able to have another one issued. Same thing here. If we can't meet the depositors' demands or get their money back, then the banking system as it is will collapse. And that's not going to happen. The government's not going to let that.
Not going to allow that to happen. This is what we know as this situation continues to develop as of Tuesday, March 14th. Checking in here with John Kuykendall, founder, CEO of GulfCoast Financial Services. If you've got questions or concerns, if you would like to put together your financially focused plan, John, how can people be in touch?
Well, they can go to us at www.gulfcoastfinancial.net. That's gulfcoastfinancial.net. Or they can call us at 386-755-9018. We'll get back with them. If we're not here, we'll take a message and we'll get back with them. Don't procrastinate. Now's the time we need to be planning. Now's the time we need to be getting second opinions on our portfolios, and we need to be getting second opinions on our retirement funds. So it's a great way to get a lot of knowledge for free. Hopefully we can give to you and impart to you.
3 generations of planners under one roof there at GulfCoast Financial Services. Your future, your family, their focus. Pick up the phone, give them a call, 386-755-9018, 386-755-9018, or you can visit online, gulfcoastfinancial.net. John, thank you for sharing and bringing us up to speed.
Thank you, Peter. Thanks for having us. It's a great topic.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities, Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services, Inc., a registered investment advisor in Florida. GulfCoast Financial Services, Inc. is not affiliated with Kovac Securities, Inc. or Kovac Advisors, Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors, including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.